Stock market analysis and projections. And we're going to look here at the S&P 500 and some other important things. First, I want you to read this slide. It talks about our approach to the markets and how you use our information. And always trade ownership is an important aspect. No matter what we show you, no matter what we give you, this is all about trade ownership. Why is that so important? Because if you don't own the trade, then you're not going to manage the risk. You're going to wait for somebody else to tell you something about it. And trade ownership is one of the key aspects of being successful. It has to be your trade. It has to be you following your trading plan. And then all of a sudden, you're going to find out that the success rate is really going to change for you. All right, so what happened in the market this week? Well, there was a monstrous move on Monday. The indexes just had huge gains on that tariff deal with China, and the tariffs were cut by 125% on both sides. That means there's a 10% tariff on U.S. goods into China and a 30% tariff on Chinese goods into the U.S. That was certainly palatable to investors. And after the UK deal, there's an indication that there's going to be a lot of tariff deals coming. And so tariffs are no longer scary to investors. The stocks just follow through on the upside all week long. Today is the fifth up day of the week, all days on the upside. And the gains came despite a collapse in UNH on a criminal probe on Medicare fraud allegations. UNH down some 53% in 5 weeks. Wow, and that is a monstrous company, about 30% down in this last week. And that hurt the Dow, but the Dow was still up about 2.5% on the week. S&P 500, NASDAQ, and they're up somewhere over 5, close to 6%. Russell up a little bit less than there. So it's a big up week for the market on top of a market that was very strong. The sentiment went from investor terror over tariffs to ebullience over the growth prospects. Now, that's kind of an important comment in here because, I've said countless times, you've probably all heard me talk about the fact that the stock market valuations got insane and we got a big correction after that. And now they're getting up to insane levels again as the market has moved up. But we saw that the market was able to stay overvalued for a long period of time. And now with the growth prospects improved, the lower probability of a recession, the investors are looking past all of that and saying, well, the GDP will do better down the road and the earnings will be higher. And therefore, we can afford to buy these stocks at these levels, even though the S&P 500 is over 190% to GDP, which only happened twice others in history, and those brought very large declines. So the market is very overbought. I'm going to say that and say to you that our analysis says it's going to try to go higher, and we're going to respect what we see. And I'm going to show you that analysis right now as we look at the stock market. We're going to look at the S&P 500, NASDAQ, Russell, and the VIX, and of course our market condition monitor, which you just got a peek of on a much shorter term usage by Matt. And I'm going to show you a special use of the reversal scout in line with what Matt showed for the near term, evaluating what a day trader would do or a short-term swing trader. I'm going to show you something in a little bigger perspective that I think is very important to look at. So let's switch over to the charts right now. So I have interest rates up there. Let's just switch over to the S&P 500 market. Let's talk about first what my initial analysis was. You see this bracket on the bottom that is grayed out, or we call it ghosted. My original analysis was that the market, and if you go back and watch what my end of the year analysis was that it would peak in here and have a decline April, May, June. And you see that the period of risk, April, May, June, and that I had anticipated that May or June would be the trough in here. I also anticipated worst case would be 5,100. But of course, we got into a panic. And when you get into panics on the downside, they reverse, and those reversals tend to make it harder to get back down to the low. So after that, I said that, well, this low over here may get tested, it may come down, it could make a lower low, but maybe it was going to make a higher bottom. And I showed 6 different occurrences in history where it made higher bottoms. And that is what I thought was the possibility. And I said this could be very well be the low for the year at that point. Still, I was looking for a test of this low of some kind, which really did not come. It pulled back, but I'll show you that. So this is what happened, and that is the harmonics shortened. Now, some people say, Slim, you move the goalpost. Well, I don't move anything. The market tells us. And it told me the harmonics had minimally shortened. So I do that. Remember, this is artistic. And what we do is look at how that information gives us probabilistic information. And in this case, it said to me, well, the harmonics had shortened in this case. And so we put in the shorter cycle brackets to help us with our projections moving forward. You may care about what happened before. I care about what's coming. And that's what the analysis is about. Now, you can see in here that the reversal scout turned up. The reversal scout is normally not this much of a laggard, and it depends on what time frame you put it on. But when you get a bungee jump like you had in here, it takes a while for the reversal scout to turn up. Mostly it doesn't lag that much, and the information from it is very good. Reversal scout turned down over here. It kind of whipsawed you as it was making the complex M top that occurred in here, and then turned over right over here. And it had tremendous value at that point. When I go over to the daily chart here, this cycle right over here could have been in the bottoming process of the weekly cycle. But the reversal was so big in here, where the first few days was, some 600 and something points off the bottom, then it was not really possible for this to get down, and it formed this very powerful right-hand translation. In other words, this peak over here came way on the right side of the cycle and then came down and made this trough. If you look at the rhythms in here, you can see that these cycle troughs were actually quite good, and you can see the cycle rhythms and they're quite good. How do we use this information really? How do I, use this for trading? I'm going to show you another kind of a chart that I constructed. Now, at some point, we're going to have this as an indicator, and we don't have it right now. I kind of like to call it my trade radar, and that's what we're going to look at right here. So here's the same charts we looked at. Here's the weekly chart right over here, which shows you the reversal scout, which is available to you if you subscribe to level 4, which we have the special on right now. And I'm showing you where the reversal scout turns were. Now, one of the great aspects of the algorithms that we built is looking for alignments in momentum conditions in different time frames. That's why we look at multiple time frames, because of how important it is. So going back to the same kind of a chart without cycles on it on the daily chart, what I'm doing in here is comparing the two momentum conditions on the two charts. So as you can see, when the market was rising over here on this chart, and you got the upward momentum turn, that was right over here on the daily chart. So here's the reversal scout on the daily chart. When the momentum is strong and the positive, and the momentum is positive on the daily chart, the zone is colored green. And that tells you, well, you want to be on the long side of the market because the impulses are likely to be strongly on the upside. When there is a declining phase in here where the reversal scout is negative on the daily chart, and it aligns with a positive reversal scout here, it's yellow. It tells you don't really look at the downside in here because this is likely a corrective phase in here. So here was a cycle that you can see and a cycle that you can see, but I don't have the cycles in here. I just want you to see using the momentum. Here's where momentum turned up on the daily chart. That was right over here on the weekly chart, telling you upside is the impulse area here. This is like our day trader, which essentially gives you the impulse monitor. It monitors 4 periods where the impulses are going to be in one direction or the other. You could see the same thing happened in here. Here, where you started to form the M top, where the momentum went negative right over there on the weekly, That's where momentum was negative here, but it turned here, but momentum was still positive on the weekly, so it's yellow. But right over here where momentum was negative on both, it's red, and you could see the impulse was on the downside. Perfect, beautiful. Here you could see the impulse on the upside again, because this is where this was green, and this is where this is green, and now look what happened. Look where the momentum turned negative right over here. So on the daily, you can see it actually turned sooner, but it's yellow there because the momentum was not negative yet on the daily. Here's where they were negative together, right here and right over here. Look what happened, the downside impulse. An upside move was yellow, and then another downside impulse here. This was that bungee jump. It fell like 900 points in 4 days here, and then moved back up 650 points. This is where I misread, because I still see this as negative, and I still saw it on the cycle as negative, but this decline was so big that there was a lag in here, a bigger lag than we normally get, because the market was moving up while this was in a red zone, because the bounce was so big, because it was a panic sell. But look what happened here. Look at the upturn right there. Look at this upturn right here. Impulses should be on the long side, on the upside, and you can see absolutely beautiful. Look at how understanding momentum on multiple time frames can keep you on the right side of the market, whereas you will be long for the upside impulses, you will be short for the downside impulses mostly. So that's, it'll be wrong sometimes, you get caught on this, but most of the time, this is going to give you just absolutely great information. Now, of course, the rest of the team puts together different versions of this. RV does trade ideas, which is phenomenal, and he uses this and the cycle analysis and all of that together. And like Matt said, what we're trying to give you is the best directional decision making. And RV's, he keeps it up there. So about 70% of the right decisions on directional decisions. So that's the key. I wanted you to see that because it's so important. It explains so well how the momentum conditions in these markets has really been strong guidance. And this is the area right over here that was negative, that messed it up and messed me up on the cycles because of this the magnitude of the decline. But now we're back in gear, and the cycles are back in gear, and the momentum is back in gear. And what this points to is the likelihood of going up towards that all-time high again. So there are some resistances before that. You see, it got through that 78.6% repair level. That was a confirmation, though the move was so big at that point that it really doesn't have a lot of value. And where are we right now? Well, we're shooting up to these target zones right over here. This is the 61.8% fib extension of this cycle. This is the 78.6, and this is the 100%. So the target zone is up in the new high area. The all-time high, 61.4743. I had originally thought the all-time high for the year, would be 61.75. Let's see where that goes. In the meantime, the bottom of this zone is 62.60. If it can get through what is pretty important resistances right over here, and what would be a 200%, GDP valuation to GDP, which is really unbelievable if we can get there again. But, if we put together the sum of the evidence here, the market is going to shoot for those all-time highs. That's really what the setup is right over here. And until it proves us differently, in other words, some kind of a failure, and right now would have to really be a failure, get under this cycle analysis at 55.76, that cycle low right there. It doesn't look like it's going to want to do that. And the background news certainly doesn't look like it's going to be negative. So the market is still moving to the upside. Slim ribbon right over here turned positive, and that is giving you that strong upside move. The slim ribbon PO here is positive, and momentum conditions all positive. The NASDAQ NDX is pretty much the same. You can see that right here. There's really no difference in here. It's pointing up to that high area right over there at 22,275. The all-time right over here, you see right there is 22,238 right there, 22,000. Oh, that's 4 ducks right there, 22222. call that ducks, back from the CBOE. So that's where it's probably pointing up to right there until it tells us differently again through that repair level there. Again, look at the weekly. The original harmonics are still in there, which were the ideal harmonics, and then the early trough that came that we then had to reanalyze what was going on. And that's really what makes us really good analysts, because we're flexible. There are so many analysts out there that are inflexible and stick to their analysis no matter what. And we certainly don't do that. We just let the markets and the charts and the information speak to us, and then we adapt. We are bull bear agnostic, and we just let the charts tell us what's there. The last one we'll look at here is the Russell RUT, and then we'll look at the VIX. Here you can see the Russell on the weekly and the Russell on the daily. Now, the Russell is actually the strongest one today, but it's still only getting up to this level here at the 50% retracement level. So the question is, are the small caps going to be able to catch up? I actually believe no. And I tell you why. I think there'll be more rally, and you can see we're pointing up over here to, near 2,200, 2,190, 2,200. This over here is 2188 right there on the weekly chart. The reason I don't believe they're going to catch up, and why the broader indexes I think are going to be the powerhouses on the upside to continue this rally, is because of interest rates. And if you are only watching this clip on the stock market, go back and watch the full show where I do the analysis on the bond market. The bond market has trouble. Interest rates have a higher probability of going up. The Russell stocks are the zombie stocks. They're the highest borrowers relative to their company size. And if that's the case, higher interest rates hurt them. The investors are going to try to make a case for this catching up, but I don't think it's really going to. And I think it's at some point going to have a harder time. Let's take a look at the VIX, VIX. And you will see here that what we're looking at on the weekly chart is that we're in a bottoming area right over here. Now, these little green circles right over there are the bottoming areas. And it takes some time to set these bottoms in here in the VIX on the weekly chart. So the stock market, there's a period of risk inverse to this potential rally in here in the VIX that comes out sometime in May, June. So the end of this month or sometime in June, there's likely going to be some kind of a corrective period, and the VIX will get a pop to the upside. If I look at the daily chart right over here, and DJV asked me, is it possible that there's a left-hand translation? Right now, I'm going to say that's low odds. And what I want to do is I want to look at that possibility, DJV, because I looked at that. And I wanted to show you the possibility. So if these are the cycle rhythms that you see right in there, if I say, well, there's a shortening going on based on what is happening in the stock market, then there's a possibility that what's happening is that this would be the low, there would be very little rally, and then the VIX market would be doing this. I'm going to tell you that I think it's low odds. However, based on everything we're seeing here, the slim ribbon PO, the slim ribbon, the reversal scout, all of that, I would say that it's worth looking at. So you brought up something important, DJV, and that's Danny. I know Danny from way back many years ago. That's an important question that you asked. And I'm going to keep my radar open for the possibility that that's the case. So I'm going to take this and I'm going to color this. This is what I do when one of my team or I see a possibility of some change in here. And now I have that cycle bracket in there to observe, and we'll see whether or not that's the case. If that's the case, that's in alignment with what we're talking about on the weekly, with this still taking some time and the stock market continuing to move up towards the highs. So Danny is a student of our work, and he had a good eye on this to look at that and say, Well, this is a possibility based on what we're seeing there. So I want to look at that. Remember, this is art form. What is the information I'm getting in here? If this goes out another couple days with implied volatility is low, then I think you spotted something, Danny. That's really important. So I wanted to bring that to you. And I think that was an important observation that you had. So that was a look at the VIX. Let's go back to the S&P 500 just so that we can look at that possibility of the VIX being in that extended cycle with a left-hand translation. That would align very much with what we have projected in here with the stock market continuing to go to the upside. Let's take a look quickly at our MCM. I'm going to bring
Slim,
Yep.
Slim, it's Matt. I had a question come in from a member, so I'd like to put your trader psychology hat on for a second, if you don't mind.
Sure,
'Cause I think it's a
sure.
really important question. If you go back to the impulse monitor you put together with the reversal scout, that grid that you did the demo on,
This one
just a
here.
couple, yes. So when you were talking about the panic low that formed, all the negativity that was surrounding the news at that time, and the possibility, right, of a retest of the low, and then the indicators shift. The impulse says
Mhm,
it's on green.
mhm.
How they want to know, how do you get out of that stuck, those thoughts of it's got to come back down. The indicators are probably wrong this time. I don't trust it, and I'm going to stay I'm not going to get in the market, or I'm going to just stay bearish, even though the indicators are sort of screaming at you, which is what you're trying to tell people, is that we build this so it almost gets past those thoughts that keep you stuck. So could you share some insight into that?
Well, there's a couple things. First of all, if the position is costing money beyond what our risk management tells us is allowed, then the position should be wiped out. I mean, that should be mechanical. If you can't do that, there are psychological aspects keeping you from wiping out the position. I can't tell you how many times I have been through that in my 51 years as a trader, where I have, had a position that wasn't working. My P&L was telling me that there was an issue, and I wasn't listening to it. And then all of a sudden, I got out of the position because it was too painful to stay in it versus listening to what actually the market was telling me. In the case of this, it depends on your perspective, what your trading style is. But Matt showed you using the 2-hour chart. So if the 2-hour chart goes positive and the daily chart goes positive, well, then at that point, you're looking at near-term or shorter-term trades. And that should be warning you that you have to be moving out of the positions. The analysis is changing. I have two criteria for my risk management. Number one, have I reached the max loss dollar wise in a position? Number two, does the analysis support the position? If it no longer does, and you're past the amount of money or near the amount of money that you allow yourself to lose on any trade, there is no reason to be in the position. You can't justify it. If you're justifying it because I've lost too much money, or I need to pay my bills, or I need to pay for the college education of my kids, or I can't make my car payment, then you're in trouble if you're doing that. So it's really very, very much about you understanding at a deep level what is driving your decisions. Are you mechanical? Are you listening to the market? It's talking to you, or are you stuck in this shadow place? And we have a video in our workshop called The Shadow, and learning about that. And I am almost done producing now called The Money Shadow, which is a prequel to it. I've got all the slides done and I'm about to record it. So I think you're going to find that fascinating. And all of that is important. Is your shadow, or what we call a risk manager, wants to protect you but is actually hurting you, driving your decisions, or are you doing it at an intellectual level? That's my best answer to this.
Excellent. Okay, thank you. We'll make sure to record that and share it.
Yeah, absolutely great. Okay, so I want to get back to looking at the conditions of the MCM in here. And Matt showed it looking at a shorter term. I'm going to focus on he looked at the near term, which is right over here for shorter term traders. And you can see that on the near term, they are all very bullish right over there, the 3, 4 indexes that we have there. I'm going to switch it over to the short term here, and you can see bullish. Now, some of these on the slim ribbon on the weekly are still negative in there, and that's kind of giving it, it's preventing it from becoming very bullish, but it's still bullish, as you can see in here. And this changed from neutral to bullish some time ago. That was over a week ago when it did that. And that's important information. If you look here at the intermediate term, you can see they're all slightly bullish because there are still some negative readings that are in there, but still turned slightly bullish right over here on May 2nd. So with that kind of a lead time in here, you're going to want to listen to that important information, because these are the algorithms that have all of those momentum conditions built into it. It gives you great information. Let's just look at the short term in here on, let's say, the top 10 stocks that are very bullish. That you can see right here. Let's just take a look at that, because you'll be able to dial into that, as you can see. And there's your very bullish stocks right over there. That's like the top 10 right there. Which are the ones that are very bearish? Let's take a look here. And there are the ones that are very bearish. And interestingly, of course, AbbVie is in there because the healthcare stocks have been going down with pharmaceuticals. You can see Bristol Myers and Merck. Those are the ones that have been weighed down by this problem with United Healthcare, and also that President Trump is trying to push down the pharmaceutical prices that you could see in there. Corn is negative. We've been reporting that. Wendy's, Heckler Mining, of course, silver stocks are suffering from the pullback in here in the metals that are in there. Let's just go a little bit further down. You could see Humana, XLV, which is the healthcare stocks, United Healthcare, Johnson & Johnson, as this cues you in to the ones that are very bearish, and the ones that you probably want to avoid buying when you get that kind of information like that. So I wanted to give you a peek of the MCM, because it is such a valuable indicator, such a valuable service that we offer. Again, level 4, the reversal scout that I showed you here on this multiple time frames, and the importance of that. Level 4 indicator, the slim ribbon PO, level 4 indicator. The MCM, if you're a level 3 member, you actually get a version of this. Level 4 gets the full version, which is with the intraday in there. So do consider becoming a level 4 member. Remember, this is the special. Go to the top right, click on that special offer, save 37% on the website. This is everything you get. You're going to see all of this. You're going to get all of it. And you're going to be able to do it for $99 versus $159 for 1 month, non-recurring. And if you love what you see, you love what you use, Matt's going to send you another special to stay on with us. So it will be just absolutely a great opportunity to learn what this team knows. And you can see we know a lot. We know stuff. I love to say that.